Hey everybody, Tim Arrowood here with People's Home Equity. We got a special guest today, Mr. Andy Warner with Veritas Risk Management. Everybody needs to know Andy, so to introduce yourself, Andy. They already know me, so we know what's going on.
Thanks, Tim, for having me on today. My name is Andy Warner. I'm with Veritas Risk Management, and we do insurance of all types. We do some personal lines, we do commercial. With Tim specifically, we usually help out on the homeowner side. So I've been working with Tim for a few years here and partnered up with him on a number of deals, and it's been a great experience for both of us.
Yeah, I agree. And I send everybody to him, and Andy, full disclosure, Andy takes care of my stuff, and we're actually working on some umbrella insurance for me right now. So we talked about that before we got on the line. So, and I will say that everybody that I deal with that's buying a home or refinancing, they have a home, they want homeowners insurance, and so I'm automatically sending everybody to Andy. Now, as we all know, they don't have to use Andy because that it's up to them, but I trust Andy and his team to be able to take care of my people, and they some people need some help getting started. A lot of people move them from out of town. They don't really know who to start with, and sometimes if they're coming from the West Coast, may have a different company that they're used to working with. They may not know anybody around here, so try to make sure that happens. So what I wanted to bring Andy on today is because everybody needs to know, even if you're not buying a house, whether it's renter's insurance, insurance is insurance. But we are going to talk about what we call hazard. In the business, we call it hazard insurance. That's always a conversation I need to have with clients. In the mortgage business, there's a lot of risk management. So there's insurance for everything, right? On a mortgage, there's title insurance, there's hazard insurance, there's mortgage insurance, there's all kinds of different things. But the one we're going to talk about is just the hazard part, or the homeowner's insurance and so I thought it would be a good idea to just kind of get Andy's take on I've got some questions here. We're probably going to go off script pretty quickly, but I just want to get some of the common questions that I have people ask me all the time, and be able to make sure we've got these in a format that somebody could watch. Maybe you're somebody that I've just introduced Andy to, I'm probably going to use this video for that. But real estate agents, some of the things that they need to know about what's going on. So tell us, what does it cover? What is homeowners insurance or hazard insurance? What does it cover, Andy?
Yeah, great question. So here's a talk I usually give when we get a new client in the office. And a lot of times they've had either a great experience, a bad experience, somewhere on that spectrum with their previous insurance agent. And, there really is no good insurance policy. There's no bad insurance policy. There's just agents that have done a better job than others of explaining what the policy covers. So,
okay.
We try to, there's a combination of price, protection, and service that go into any policy.
Okay.
If you want absolutely everything that could possibly ever happen to you covered, I'm sure we can find a policy for that. You're going to pay for it.
Right.
And it gets expensive really, really quickly. Others have different goals, and they're like, man, I wouldn't even have this if I didn't have the loan. Tim's over there making me get this insurance. Just get me the cheapest thing you can. Well, if you don't care how much, what kind of coverage you got, we can find something pretty doggone cheap for you. But you gotta measure those two, and typically you can get 2 out of the 3. You're going to sacrifice one of those 3: price, protection, and service. So if price and protection are really important, hey, you may get a good company, but can you get a hold of them at claims time? Well,
right.
That's kind of where we start on that. So the idea is you start with the structure.
Okay.
You look at a policy form. Most of them now list it as the dwelling on the declarations page, which is the cover sheet for your insurance policy. But it's listed as coverage A. So it's the primary, it's the most important thing. Mm-hmm. That's one Tim and his underwriters are concerned about is,
right,
we're giving you this X amount of money for this house.
Right.
We want to know if something happens that
our collateral, because the money, if there's no house, there's no collateral. And so it's kind of hard to, absolutely.
Yeah. Well, and then on the personal side, all of my stuff is in there. All of my clothes, my furniture, that sort of thing. So that's coverage B, or contents. I'm sorry, that's coverage C. Coverage C is contents. Coverage B are other structures. So things not attached to the house. If you've got a little outbuilding in the backyard, a little
Okay.
shed that you bought from Lowe's or Home Depot, that
Right.
sort of thing falls under other coverages. It's not attached to the house. It's there on the property, but it's a separate structure. And then
Right.
coverage C is your personal contents. You're stuck inside the house.
Okay.
And
that would be like if you were renting, you would just get coverage C.
Because so a lot of folks will call that a renter's policy or a content policy. But that's coverage C without the dwelling or other structures coverage on there.
Makes sense. Okay.
And then for some reason, coverage D, there is a coverage D. It's buried down in the policy. No one really draws attention to it. But coverage E is liability coverage, and that's what covers you if someone comes on your property and they trip going up the stairs, or they fall off the porch, and hey, you should have had handrails there. The coverage E is the liability that's going to protect you. And so the idea there is the assets that you have. You want to make sure that your liability coverage is greater than your assets, because if something happens, you want someone going after the insurance company, not after your home and your retirement account.
Got it. Okay. That seems pretty straightforward. And we're, when I think about the things that we require, we need to, there's a form in our package that says you can use anybody you want for insurance, but they have to meet these certain minimum requirements, and the one that the two that I remember off the top of my head is, the deductible can't be too high as a percentage. I don't remember what that percentage is, honestly. And the other one is it needs to be full replacement cost value.
Yes.
So what does that mean, full replacement cost value?
So what most insurance companies will do, we use different software programs, rating programs that take into account the cost of building materials, average cost per square foot, whether you have linoleum or marble as your flooring.
Okay.
And we calculate within range what it would cost to rebuild your house as it stands today. And that is the insurance replacement cost for that home.
Okay.
So old insurance policies, ancient insurance policies would cover what's called ACV, or actual cash value of a policy. And that would be depreciated value. So, hey, you're 20 years old. I know it costs you $5,000 or $10,000 to put it on, but hey, those shingles were 20 years old. It's pretty much worthless. We'll give you $2,000 to redo that roof.
Okay.
Okay. Now you're up there. So replacement cost just says, hey, your house costs $200,000, $100,000, $1 million to build.
Right.
We're going to make sure you got $1 million to rebuild it.
Okay.
Now, one of the cool things that you get into with some different carriers, there are some other terms insurance companies are always looking to get creative and make an extra dollar.
Right.
The way this has morphed over time is some of the new policy forms take into account the experience of the insurance company. So you get more recent rates, which in many cases are less expensive than replacement costs. So we've got one carrier, for example, that offers what is called extended replacement cost. So that gives you, if your house is, say, $200,000 home, you get to $200,000 plus an additional 20%. So an additional $40,000. So why do you need that? Well, right now we're in a situation, if you've checked out lumber prices, when coming out of COVID in July of 2021, lumber is through the roof.
Right.
A year from now, who knows where that'll be. The other thing that most folks don't think of, you're going to have some debris removed. If your house is just burned, you've got maybe half a house left to tear down. And what are you going to do with that debris? And do the landfills charge to haul off that?
Wow.
So it may cost $200,000 to rebuild the house, but what about clearing off the site and prepping it and that sort of thing? So extended or full replacement cost is often available, and it's cheaper a lot of times than just standard replacement cost. So it's a conversation that we like to have with our clients to make sure that they've at least got replacement costs just to fulfill TIM and the more requirements. But
exactly.
A lot of times we can offer even better coverage at a better rate than that.
Okay. So I want to go, the next one is how are rates calculated, but I mentioned just a minute ago about deductibles. So if you've had insurance, I'm an old guy now, so I know what a deductible is. I've experienced the deductible, but for those that may be just getting started and they're, what is a deductible?
Yeah. So the deductible is the amount that you are responsible for if a claim should happen.
Okay.
So let's say you've got a $10,000 roof claim and your deductible is $1,000. Well, the roofer sends the bill in. It's a $10,000 bill. Insurance company is going to pay $9,000 if you have $1,000 deductible. Obviously, if you have a $2,000 deductible, the insurance company will cut the check for $8,000, and then you're responsible for the other $2,000. So the idea there, the more risk that the owner of the home takes on themselves, most of the time, the less expensive their rate. So the higher deductible you carry, you pay less for insurance because you're taking more of that responsibility on.
That makes sense.
We will look at different options. If you call us for a quote, we're going to look at different options. And sometimes you look at that and you'll go from $1,000 to $5,000 deductible and see $100 a year difference. And you're going, math on this just doesn't work out. Why would I have to do that? And so it's on a case by case basis. And I think your next question was how are rates calculated?
So they roll right into that one for me.
So this has been really interesting, and it evolves over time. It's so fascinating to see. If you have never encountered the guys that set the rates for insurance companies are called actuaries.
Yes, they got the little glasses and the little hats and.
Oh yeah, I've got some friends that are actuaries, and they are just so fun to make fun of because they live in a world all their own. And I mean, these guys are mathematicians to the nth degree, and so the actuaries have gotten creative over the years and looked at different things and how are we going to. It used to be if you were older, insurance was cheaper than if you were younger, even on auto rates, because, hey, you're past your party years, you're probably going to maintain your house well. This generational things, the older generation took better care of their house than the new generation. So over the years, this is more what most companies use now is similar to a credit score. It's called an insurance score, but it takes some of your spending habits and the balances on some of your accounts into account and uses an insurance score to calculate your rate. The insurance agent will never see what your insurance score is in most cases. That's confidential, but it's factored onto the backside of our software, and you will get a notice that, hey, you've got too many open accounts or past due accounts or whatever. And it never, how this works, Tim, is amazing because it never, I know one of the talks you give your folks is don't go opening any new account. Don't let anything touch your credit score. And it doesn't. You'll never even see an inquiry in most cases, from the insurance company. But yet it has access to some of that same information. So it pulls from that. And when this first came out, insurance agents, especially on the auto side, we all bucked it. We said, this is crazy. What does somebody's credit report have to do with claims on their house? I mean, this doesn't make any sense. Until we started seeing the studies that were behind this. And the folks with the lowest tier credit rating, in most cases, now you see it all the time too. And you get folks that we are painting very broad strokes here. There are circumstances all the time. And this is not meant to dog or make anybody feel terrible about themselves or where the credit score is at, but
it's a reality.
In reality, and painting with broad strokes, the lowest credit scores, insurance scores, have the highest instances of claims. It's indisputable fact. You can go back and look at the studies, and the highest credit scores as a whole, the lowest incident of claims. And so all the agents kind of had to shut up at that point. It was like, regardless of what our personal opinion is on it, the experience speaks for itself. And so that does come into play. And that got two homes side by side, and that'll come into play. But more than that, prior claims are going to have the biggest bearing on the price that you pay for your insurance. If you've had 2 fires and a theft and a tree fall on your house, be prepared to pay. It's like you're never going to beat the house. The insurance company is always going to win. And so there are carriers, and that's where it's important. That's one of the things that we do. We have a number of carriers that we work with, and so we don't just represent one company. And we can go out and find a specific carrier for your specific situation, to help find the best fit for that.
That likes that particular risk profile, or they're comfortable with that particular risk profile. So that's fascinating. So I knew some of that, but to hear you say it is really, really helpful, because now we're talking about the individual, but then now the property itself has got a score too, right? Or something.
It does. So the biggest factor there is how close you are to the fire department. And
Really?
what equipment does that fire department have? Now, in Kingsport, Johnson City, Bristol, here in the Tri-Cities, we are very, very fortunate. And Johnson City city limits has one of the highest fire department ratings in the entire nation.
Really?
Which is fantastic. The higher, I say the highest,
Yeah.
the higher the better.
Right.
And so it's like they're in the top 10% of the entire nation. So
Really?
we are very fortunate around here. But, you know, Tim, you write houses all the time in very rural areas. And
Oh, yeah.
I started my career out in Cott County, and there are portions of the county that still don't have cell phone coverage. And one of the magic numbers, and this is old school, but it still applies. If you are more than 5 miles from a fire department, just be prepared to open up your checkbook, and you're going to pay more for insurance. 5 miles is the traffic radius
Really?
from the closest fire department. So the further you are from that fire department, and the lower the fire department's rating, the more you're going to pay for your insurance. So as the property itself goes, that's the biggest factor.
Does it matter that it's a like a volunteer fire department versus a paid professional?
It can. In most cases, the city-owned fire departments, Johnson City, Kingsport City, are going to have a little more funding. Folks paying for city and county taxes, and the county is going to have decent funding. The city's going to have even a little bit higher level in most cases.
Yeah.
So the volunteer fire departments now, you'll encounter. We've all seen the fire departments doing their fundraising drives and that sort of. As an agent, I've always thought some of these communities, if they would just all band together and get their fire department some new equipment, everybody across the board, it doesn't matter which insurance company you're with,
got it,
see a decrease in your rates. And it can be something as simple. Talk with the fire chief in your area, because I mean it can be something as simple as new hoses.
Really?
Lower that rating. So.
Really?
Trust me, they know it's like restaurants and their health scores. They know exactly where to stand and what it takes to get to the next level.
That's interesting. Okay, so let's say that I've got a great rating. My house is like right across the street from the fire department, but it was the previous owners they had that low rating, right? Yeah. Because they were just there was a kitchen fire. That was, I didn't have anything to do with that. I mean, that was the house before I got into it. And, this happened and that happened. So there is some legacy that comes with that, right? There
is, yes. So in most cases, we will see prior claims on that property, which could be really helpful. Just as the new homeowner, it's nice to know what's happened to your house before.
Yeah.
Because it may be 3 or 4 owners deep.
Right.
But it will show up on some of the reports that we run. Now,
you're like a Carfax. Yeah. Carfax on a car, so you can see. Okay, got it.
Now you aren't necessarily going to get tagged with a higher cost just because the previous owner had a claim, but the agent will ask if the repair was damaged. So if we pull the report and there was a hail claim in 2012,
right,
and you tell us that your roof was last replaced in 2008, we're going to have some questions. And so and there's a variety of answers there. Some companies will just flat decline you. Hey, we're not going to take a roof with prior hail damage. Others will say, hey, we'll cover it, but we're going to put an exclusion on any further roof damage. So there are ways to handle that.
Okay.
And then, as soon as you let us know, hey, we've replaced the roof, that exclusion comes off and it's good.
So let's say I know a lot of folks got some friends that flip houses. So, they're buying a house that's rough. I mean, rough. So, and, there may have been claims and there have been times when I've seen, some challenges as far as that, but then we've said, well, wait a minute here. I want you to go look at the place, or here's a list of all the improvements that were made. And that made all the difference in the world. It's been a while since I've thought about that. Is that a realistic scenario?
Oh yeah, absolutely. And that's, we like to go out and see the houses. We'll get updated recent pictures of the homes.
Right.
Especially in a market like what we have right now, houses are selling so quickly. The pictures aren't even getting posted online sometimes before the house is sold. So there are going to be drastic changes for better or worse.
Yeah.
And I've been on home visits before where you pull up and they take a quick picture from the front yard. It looks great. And you walk around the back, you're like, what happened to the house on the front side? Like, this is a disaster back here. There's 3 old cars, a swimming pool blown out.
Right.
old tree house falling down. Right. This is a problem. So, and by the same token, it's exactly what you mentioned with the flips and some of those other scenarios, Tim. Pull up a house online and you're like, oh my goodness.
Yeah.
Tim's giving how much money away to buy this house?
Right.
You can look at it and it's been beautifully redone. So
yeah. Okay. Good. That's helpful. All right. So how much insurance do I need, Andy? All of it.
Question.
All of it. That's what you're going to tell me, right?
Yeah, right. No. So here's the way to look at this. If you are getting a loan with Tim, they're going to require that you cover that house for the price of the loan or the value of the home,
right?
Whichever is, however that works on their side. So that can be a consideration. But again, broad strokes, general insurance theory. Here's the way you can handle risk. And the name of our company is Veritas Risk Management. So there are 3 ways to manage risk, and use the acronym EAT. So I like to joke that I eat risk for breakfast. You can eliminate, assume, transfer. So in the case of a home, you can eliminate the risk. Well, how would you do that? And you see that with things like sprinkler systems.
Okay.
Some of the home security companies offer water detection units. So put them in front of your washing machine and dishwasher. And if there's water that hits those sensors, the alarm goes off, the water gets off.
Right.
You get significant discounts for that. So you eliminate the risk.
Okay.
The second one is assume the risk. The AEAT, assume. That's where the deductible comes into play. And that just says, hey, you know what? I've got X amount of dollars sitting over here in my bank account. I'm really only getting this insurance because Tim tells me I have to have it. So take on the risk yourself. And that will bring down the cost. And then the last one is T and transfer. And that's where your insurance company comes into play most of the time.
Okay.
What you're going to do is you're going to transfer the risk to us. I'm going to pay you $1,000 a year.
Right.
If something happens to my house, you're going to give me $200,000 back.
Right.
That's the idea. So how much do you need? Depends on what you're trying to accomplish. And in most cases, folks want replacement cost on their house plus the debris removal type thing.
Right.
And for most of us, losing your home would be a devastating proposition.
Yes.
Most of the time, the biggest investment that folks have, and the biggest purchase they've made, and to the thought of losing that would just be financially devastating. So that's where the insurance company comes in play. We want to transfer that risk so that it doesn't it becomes an inconvenience, not a devastation. And one of the cute little sayings I heard when I started this industry, and I really like it, is, as an insurance agent, I want to be the best part of your worst day. And so when that terrible thing happens, we want to be able to come in and not go, hey, sorry, but that's not covered and that's not covered. Trust me, on our side, we want to see the claims covered. We want to see. So managing that deductible, managing the amount of coverage you've got on the home, all of that comes in.
Yeah. And that, as you said that, it makes me think of, the value that you bring, and the other local agents that, you're the guy that, that's coming over, while they're still trying to get the fire out, and you're checking on somebody that's become a friend, and, you're working alongside, as opposed to, I can't get anybody to answer my calls at the call center. What do I do? Being able to be there. I mean, you got to live in the community. One of my rules has always been, I want to, I may not be, I'm going to make mistakes, but at least I know that when I see you at the grocery store, I'm not going to have to go down a different aisle.
Yeah, exactly right.
You may not like me, but it isn't going to be because I didn't do my job, or, we're going to do everything we can. And I can, I'm not going to avoid you that way. So yeah. Wow. That's good. That makes a lot of sense. Okay. So I don't know. I've got a bunch of questions here. Maybe how long have we been going? We've been going a little while. So, what did I just how much do I need? We talked a little about a deductible. What should you set your deductible at? It sounds like that, it's kind of like if you were doing health insurance, you could be self-insured.
Yes.
Like if I've got $1 million in the bank, then I want the catastrophic, or whatever you might call that.
Yeah.
Okay, that makes sense. How about personal liability protection? How much of that do we need?
Personal liability protection. This is a fun one. So How much do you actually need?
Wait a minute. You just said insurance is fun. So that's the reason you're doing that and I'm not doing insurance. So go ahead.
I tell you, because this is the part you think you will never ever use, and you hope and pray you never ever have to use.
Yeah.
And we had a situation, agency I was a part of, that guy was building a new home and brings his best friend over to look at the property. And so they're walking around and they're admiring. They had tongue and groove ceiling on this beautiful cabin.
Mm-hmm.
They're admiring the ceiling and the work that's done, and forgot about the hole in the middle of the floor that went all the way down to the basement. And so his best friend, of course, falls, goes all the way down, breaks both legs, breaks his back. Horrible, horrible accident. Well, these guys are best friends, but his buddy has $500,000 worth of hospital bills and surgeries and physical therapy.
Mm-hmm.
And he's like, I don't want to sue my best friend. Well, we get the sentiment. We don't want you to, but he's got $1 million liability policy.
Right.
And that's the part that's going to pay your medical bills. And
right.
So that's a case you always think, man, no one's going to sue me. And you hope and pray that they don't. But sometimes the suing somebody just becomes an instrument to access the funds. And so what liability coverage will protect you is in a case of negligence, that you should have known better. The guy should have had railings up against to protect.
Right. Right. Right.
And so that's where the burden of proof lies on to access the liability, is that there was negligence involved.
Mm-hmm.
Now, attorneys, used car salesmen, insurance agents, I mean, we're talking about guys at the bottom of the food chain, right? And so all the horror stories. What should you have done? Should you have had a handrail on a 1-foot porch? It depends on how good your attorney is. So that insurance is about eliminating or transferring risk.
Right.
And if you have the worst case scenario happen, that liability, personal liability protection is what's going to be in play to make sure that they go after the insurance company, and not after you personally. And the money that you've been able to save and the assets that you have.
Right.
So as a minimum, again, most folks, their biggest asset is their home. As a minimum, at least carry more than the value of your home. So if you've got a $100,000 house, don't carry $100,000 worth of liability insurance. Carry $300,000. If you've got a $250,000 house, don't just carry $3,000. Carry $500,000. And I'll give you an example. To go from $100,000 to $300,000 for a lot of folks, and again, it's a sliding scale. So this is it's about $25-$30 a year for that much extra coverage. So really need to look at that. Now, and then if you're in a position where you've been fortunate enough, you're possibly later in your career, and you're close to retirement, you've got your nest egg saved up, you've got your ducks in a row, or even if you've just been blessed and fortunate ahead of that time, you need to look at an umbrella policy, which will cover you above your homeowner's limits, above your auto limits, and come into play to give you an extra $1 million, $2 million, $4 million, however much needed there. So that's a conversation we have on a case-by-case basis. But especially if you've got more than one property, if you've got some investment or retirement income there, you need to make sure to protect. A lot of times we need to go to the $500,000 limit and then look at an umbrella on top of that.
Yeah. Okay. That's we've covered a lot of good stuff. So I think we've covered this, but real quick, how can I save on my homeowner's insurance? I think you talked about that, eliminate. So you're either going to that above ground pool that you have. If you took it down, then you're probably going to save money on that. Or you probably wouldn't even insure a place that had an in-ground pool without a fence around it. Right. Yeah. So that's one of the elimination, right? Exactly. You'll be looking at, and then, I kind of jumped in there. So what are some of the highlights there for save on the homeowner's insurance?
Yeah, no, and you're right on track. There are a lot of endorsements, which is a fancy way to say add-ons to insurance policy. Yeah. Some of them are really nice to have. Others, it's on a case-by-case basis. If you don't have jewelry, spurs, and silverware that's passed down from generation to generation, why do you need that much coverage? Yeah. and so there are certain things that can be done, and there are cases where, as I mentioned before, eliminating some of the risk or assuming some of the risk, where you take it on yourself and say, you know what, I know I've got X amount of dollars worth of guns and trading cards and some collectible artwork. I'm just really not concerned about that. If I lose it, it'd be a big loss. It'd be a bummer, but it's not going to wreck me.
Right.
So eliminating some of those things and just knowing what is in the policy, kind of where I've started. There's not a good policy or bad policy. There's just better and worse explanations of what that policy is going to cover.
Right.
Making sure that you're not overinsured is a term we hear a lot. I feel like I'm just overinsured.
Yeah.
Everybody feels that way until claim time happens. And that's when you don't want to be going, oh, shoot, I wish I had. We've had calls at folks that don't know better, but man, I just had a car accident, or I just had a fire, or I just had a, whatever. I've been meaning to up my coverage. Is it too late to do that?
Oh my goodness.
Yeah, it's too late. That would be illegal. That would be fraud, and we're not going to go there. So don't wait till it's too late.
Right.
That conversation.
Wow. Okay. And so, and this just this could be probably a whole conversation. But how about dogs?
Oh,
that's got to be a big one for. Our cats don't get into a lot, so we don't really worry about that. But
I tell you what, so yeah, but other than insulting somebody's wife or their child, probably insulting their dog is the next best way to really hot water with them. It is such a sticky conversation, and different companies have approached this, and it's another thing that's evolving over the years. We have some carriers that they don't care what type of dog you have. They just want to know if that dog has a bite history. So it doesn't care if it's an old bloodhound that never gets off the porch, or if it's, a pit bull that's trained to protect you. As long as the dog hasn't bitten anybody, they're fine with it. Go right ahead.
Right.
Others have a list of dogs that they'll exclude, and
really,
dogs typically seen on that list would be any pit bull. So even if it's a mix, chows, some companies even German shepherds. So those are the three. Akitas. I'm trying to think of some of the others that are typically listed, but company by company basis. So if you have a pit bull, not necessarily a deal breaker. It is with some companies. Yeah. But we have others that will write you as long as that dog doesn't have a bite history. Now, if you do have a dog with a bite history, please, whether you use me or another agent, please disclose that. Don't try to hide that. Okay. And there are ways around that. You can, and some companies will allow you to exclude the dog. So, hey, we know this dog has a bite history. We're still going to cover your home. We're still going to cover your contents. We're just not going to cover any dog bites. So they'll put an exclusion against dog bites on there. Some companies, it's going to be a flat decline. So have that conversation before your insurance agent puts in the application. Because here's what you don't want is, hey, I didn't know this. I've applied with a certain company. They've approved it. We're good to go. We get ready to get down the closing table, and for some reason you feel prompted to call me and let me know, hey, I forgot to ask you, but I was just talking with my neighbor and he said y'all don't cover pit bulls. What's up with that? Oh, shoot. Well, I've put you with a company that has a pit bull exclusion. So we get into this and your dog has bit somebody. Well, now we have a decline. Every insurance carrier in the world is going to ask you as part of the application process, have you ever been declined coverage? Well, now you have that question. So if you put it out there in the open before the application is put in, that eliminates some headache down the road. Got it. Okay, cool. So why should we work with? I'm going to wrap up. Why should we work with Andy? Oh, love it. Here's your chance. I'm throwing you a softball. Knock it out of the park, buddy. How do you brag on yourself? So here's where I typically go with this. My background, I have a master's degree in counseling, in pastoral counseling, Christian counseling. Oh, okay. And so I'm a trained listener. I'm a professional listener is where I try to go with that. And if you've had experience, to all my friends who are car salesmen, I apologize, but I hate going to buy a car because I always end up feeling like I bought what they wanted me to buy, not what I really wanted. And if I want what I really want, I end up with an argument over either the car or the price. It's just a miserable experience. Right. You didn't have that experience when you go to your insurance agent. And so having somebody that knows how to listen and knows how to ask questions to probe to that next level deeper, that knows what they're talking about to ask the question about the dog bite. Not because we're trying to exclude or save the company tons of dollars. We're trying to help you out. And that, so that's the difference. And I typically will start out by saying, you know, again, the best part of your worst day. I love that phrase. But we've helped hundreds, thousands of folks from, you know, teenage drivers all the way up through seasoned retirees, protect their assets, the things that matter most to them: their home, their cars, their business, and their family. And that's our goal.
Right. Great. All right. Well, he's the only one that I send people to. So, you know, at least for now. So we'll see how my umbrella policy comes back here. So
that's right. We'll see how bad we make that hurt. No, the name of the company is Veritas Risk Management, and that's one of I love the agency that we've been able to build, and Andrew Darlington started the business. I was able to join him in the business, and Veritas, if you're not familiar, is a Latin word that means truth. And so our tagline is just telling the truth about insurance. And I promise you, we've been very, very blessed. We love writing new business, but we're not in a spot where we have to have new business. We want what's best for you. We genuinely want what's best for you. And if there's, for some reason, that you're not the best fit with our agency, I promise that we will tell you that. We'll look at your current policy. We'll evaluate that. And we are not afraid to say, hey, you know, you'd probably be a better fit here. We love writing business. That's how we feed our families. Trust me. If we do it, we will do it. But we genuinely want to do what's best for you. And our goal is to always tell the truth about insurance. Yeah.
And that's my experience. So we're going to put something in however this goes out, we're going to be putting it on Facebook, and we've got several different things. But what's the best way to reach you?
Sure. So cell phone number or number here at the office is area code 423-328-8434. 423-328-8434. Veritas RM for risk management. VeritasRM.com is our website. So you can check us out there, and we'd be glad to do whatever we can to help.
Cool. All right. Well, if you guys have any questions, you know, call us, call Andy. We'll take care of you. All right. Thanks for joining us, Andy.
Awesome. Thanks, Tim. Appreciate it.
All right. Bye-bye.
Bye-bye.